Oh, Greece in default,
In
right?
default, right.
Kind of,
yeah,
as you said.
Yeah, we're going to get into that now. We have a big show. We're going to be talking about fashion. We're going to be talking about insider trading. And just like the New York sports pages have been leading with Jeremy Lin for the past month, we're going to be leading once again with Greece. And here to talk to us this morning is Stephen Bernard. How are you?
Good. How are you guys doing today?
So, last night, S&P came out and they put Greece in the selective default, which was kind of expected.
Very expected. They basically telegraphed this as much as you could telegraph anything a few weeks ago. What they said a couple weeks ago was that once Greece's parliament retroactively approves a measure adding these so-called collective action clauses onto all Greek bonds that are already outstanding, they don't even have to use the clause, they just have to put it in the bond. That's enough for a default because that changes the terms of the bond. And what that clause means is basically that if a certain predetermined number of people agree to the debt swap that's upcoming, then everybody's forced to take it, whether they approve it or want it or not. And changing that term is enough in the eyes of S&P to say that this is a bad term for the bondholders. This is not something they expected when they first bought the bonds. Default.
So as you said, it was well telegraphed, and the contingency plans are in place so far. How has the reaction been? Has the reaction been as expected, or has there been anything unusual with the reaction?
The reaction has been very muted. You would expect oftentimes, even just for a few minutes in, say, the euro or markets like that, particularly the euro, a few minutes worth of reaction to the news when the headline comes out. Even if everybody expects it, you still expect something to happen. This really wasn't the case. It didn't even get that. And it might have also been the timing of day, 4:30 in the afternoon, New York time.
Yesterday.
Things are right. Yesterday afternoon, that things are very quiet in Europe because obviously it's 9:30, 10:30 at night there. In the U.S., markets are just about wound down for the day. Japan and Asia haven't really kicked in yet. So it was really in that lull in the market.
So the timing was really
right. If they had done this, if they had done this 2 or 3 hours early in the day, I think you would have seen a bigger reaction. But as it is, like we've said, it was telegraphed. One of the big questions still up in the air is what ISDA going to do tomorrow regarding credit default swaps and whether or not they decide to even look at this as a trigger for paying out credit default swaps. That's the bigger so-called default with Greece.
And so that's the big question, right? I mean, I guess in 2011, when everyone was worried about whether Greece was going to default or not, everybody was talking about whether this would be a disorderly default or an orderly default or something like that. I guess now the sense is that this was so well telegraphed and it's not quite a total default, but I mean, what's the? I guess the CDS is the big question mark right now, right?
Right. You're basically deciding whether or not you're going to pay out what's essentially insurance for people who have taken it up on Greek bonds. Ratings agencies say they're in default, but that doesn't mean that the group that decides if insurance is paid out on bonds is going to call it a default as well. So they are discussing tomorrow whether or not to even take this up. One of the bondholders has gone to them and said, could you review this and tell us if it is a default, should we get paid on this as a default, because we are holding insurance right now, CDS insurance. So that's a really big question, because you're talking billions of dollars then potentially changing hands. That could mean losses, decent sized losses for some big banks around Europe. And when it comes down to it, it's the money that matters.
And is the coalition that's pledging the money to Greece still in place?
Yeah, everything seems so far in place. They're still going ahead with a debt swap next month, the beginning of next month, I believe March 11th, 12th, around that time. So it's a matter of the collective action clause will determine whether or not, whether they use it or not is still up in the air as well. So whether or not every bondholder gets sucked into this because of this new clause that they've retroactively instituted, that's still a question too. Exactly how many bondholders are going to participate, and whether or not Greece is going to force everyone to participate by adding in this new rule.
And really quick, and so S&P made this announcement yesterday. Any sense about what Fitch is going to do, or any of the others?
Fitch has basically said they're going to put them in selective default once the bond swap happens. Moody's hasn't said exactly when it's going to happen yet, but they've basically said that eventually they're going to put them in default as well. All these defaults are going to be temporary. Once the new bonds are issued in the default swap, all the new bonds will get newly rated, which will take Greece out of default, but put them, maybe we're talking 1 or 2 notches above default. S&P has said that once new bonds are issued, they'll probably get a CCC rating, which...
And then the debate will start all over again as to what exactly that means.
Triple C is, it might as well be as close to default as it can be without being in default.